industry and a group that certainly has cornered the market in their area of expertise. So we're all very excited to hear their insights on how the property market is moving more generally at the moment. Before we dive into that, and before I hand over to James to give a bit more of an intro, I just want to do some general housekeeping as always. So just like our lunches, we encourage our viewers to be as interactive as possible. So throughout the presentation, if anything piques your interest, if you have any queries or comments, please guide yourself to the Q&A button at the bottom of your screen. You can submit questions either anonymously or under your own name, and James will endeavour to get to those throughout the course of the presentation. Any other issues, or if you just wanted to reach out, you can use the chat function at the bottom of your screen as well, or otherwise I'm around via text, email, whatever it may be. Other than that, I hope you enjoy the presentation, and that's all for me. James, over to you.
Thanks, Perry, and good morning, everyone, and particular warm welcome. I'm surprised we've got 18 Melbournians joining the call today, so I'm surprised none of you are on the golf course, but we'll see what the numbers look like in about 10 minutes. So welcome. It's a great topic. Terrific manager, Charter Hall, and David Harrison's load of experience, and we've also got Miriam Patterson, who's a portfolio manager of a particular fund the guys will talk about later in the presentation. But I think what I find interesting is that we're not going to have a deck. David's going to have a bit of a fireside chat. He's really going to cover what's happening as one of the largest REITs in the country. I think 43 billion funds under management. They've been through various cycles. David will sort of give his impressions of what happened during the GFC, what happened now, any parallels, where are the opportunities, gearing, all the various sectors. And I think what's fair to say is that the diversified REITs have been the best performers. Those that have specialised, particularly in retail and office, have been hammered pretty much on their share price. So David will sort of talk about that. So David, I think I first met you way back in the early 2000s. And do you want to just take us a little bit through your history and the firm and bring us up to current days?
Yeah, sure. Look, I guess brief history for myself. I've been in the property industry for 33 years. I've helped build two pretty small businesses from, around 10 people to my first business was buying Raine and Horne Commercial from Max Raine and then growing it into 900 people, which is now known as Savills. As a real estate agency business, diversified across all sectors, and one of the biggest managers of shopping centres at that stage, because we also acquired a business called Buyvan. Then in 2003, I sold my shares to Savills. Had a year of fun doing deals and not being a shareholder, and that novelty wore off, and then came into Charter Hall as a small private company in 2004 as a shareholder. Within 6 months, we listed the private company, stabled it to a property trust, and Charter Hall Group, as we know, was born in April 2005. In that time, the business has gone from about 300 million of assets under management to close to 45 billion now. It'll surprise many of you that we're actually the largest owner of real estate in this country by value, even larger than Westfield or Scentre Group. It'll probably also surprise you that if you look at pure industrial property logistics, excluding sort of office buildings in Macquarie Park and South Sydney, we're actually got a bigger industrial portfolio in Australia than Goodman. Now Goodman, frankly, has been a fantastic business. Their model is exactly like ours. It's a capital light model where we manage institutional capital, and in our case, the reason why our total shareholder return has exceeded the other large caps in the REIT sector and actually exceeds Goodman over the last 3 years is that both ourselves and Goodman have focused on return on contributed equity for our shareholders. And by stapling a property trust, in our case, that invests solely in all of our funds and partnerships, to a funds management business that has got the scale that we've got, we've been able to produce, very attractive returns on contributed equity for our shareholders, drive, double-digit EPS growth over many years, and most importantly, for the investors in our funds, whether you're a super fund or a global pension fund or an insurance company, or a sovereign wealth fund, through to the very important sector of the market that we also dominate in, which is high net worth capital, family offices, and retail equity, whether it's advised or direct self-managed super funds. Our fund performance has outperformed both benchmarks and virtually all of our peers. And at the end of the day, given that a pretty significant proportion of my wealth is invested in both the funds we manage, and obviously in the headstock that I am the CEO of, I think there's a pretty strong alignment with my senior executive team. Many of our directors are invested in all of our funds and partnerships. So Charter Hall Group is a snapshot, as I said, close to 45 billion of assets, where obviously one of the market leaders with Goodman in industrial. We're the second largest office owner in the country at 21 billion. We're also now the largest owner of Bunnings assets in the country, exceeding Bunnings Warehouse Trust portfolio by value. We also have really created a long while thematic throughout a lot of our funds and partnerships, driving the ability to deal with government and particularly corporates and do sale and leaseback transactions with lease terms typically anywhere between sort of 15 and 30 years. That thematic has been borne out in the US with a very large triple net lease sector in the US, which in total has a higher equity market capitalisation than the whole of the A-REIT index in Australia. So well over 120 billion. From a, if you like, a strategic perspective, we're not the only ones, but 7 or 8 years ago, we publicly espoused a view that we would see a lower for longer environment for at least a decade and probably 2 decades. I just took a view endorsed by our team and the board that the world was going into a low growth, low bond yield environment. And that has been obviously helpful in propelling cap rate compression and discount rate compression for real assets, both property and infrastructure. And I don't see that thematic changing anytime soon. I don't think global economies can afford a J-curve spike in interest rates. There's no doubt central banks around the world, including our RBA, are very intent on keeping rates low to try to stimulate the economy and deal with what's going to be a once in a lifetime pandemic for all of us. So from a Charter Hall perspective, as I said, it's in our DNA to manage other people's capital. We co-invest with all of our funds and partnerships. A lot of questions I get from the top end of town with some of the biggest global pension funds and sovereigns in the world is what happens to real estate if bond yields rise. What I can tell you is that don't listen to me, listen to the foreign capital that is choosing to invest in Australia when they don't need to invest here. The likes of GIC, Allianz Real Estate, Public Sector Pension Fund from Canada, all major investors of ours. And they are telling us that they think on a risk-adjusted basis, the Australian economy and the Australian commercial property markets look very favourable compared to any of the alternatives they can see elsewhere in the world. And that's why you're going to continue to see, despite the liquidity constraints put on the Aussie super system with the compulsory 20 grand membership redemptions, we're going to see a lot of foreign capital investing in this country. We've recently announced several transactions to evidence that. Allianz Real Estate joint ventured with one of our wholesale funds, CPIF, to buy an Audi portfolio of logistics assets. GIC have partnered with us to buy the Ampol, or what used to be called Caltex service station portfolio on 20-year triple net leases. And that's just two examples of what I'm talking about in terms of foreign capital interest wanting to invest in this country. If I go through each of the sectors, there's no doubt, and it'll be no surprise to anyone in the audience, that logistics is going to outperform most sectors. It's got numerous tailwinds, but three simple ones. One, unlike most other sectors, the income line has not been severely impacted by the pandemic. In fact, the demand for logistics space has accelerated given the rise, and I think it'll be a structural acceleration of e-commerce and online retailing. It's also the most underinvested of the major core sectors for Aussie super funds, global pension funds, and sovereigns. To give you an idea, when I started 33 years ago, industrial wasn't even rated as a core sector by your major super funds and mutuals. Now there's an appetite for most major investors to have 25 or 30% of their core portfolio invested in industrial. And on average, across the equity that we survey, both existing investors and prospective investors, the average allocation industrial is less than 10%. So we have got a huge runway of demand driving equity into acquiring logistics assets. The one thing about that logistics sector, if you do not manufacture your own product and you do not have a very experienced development team with strong relationships with the major tenants, you can't produce institutional quality industrial assets. And any good institutional industrial assets that people own, they're not selling them. So you need to have a developed a core strategy, and you need to have a platform that can deliver that. We have that. We actually have the largest pre-leased development pipeline in industrial in the country at the moment. And we're replenishing our land bank fairly regularly. So logistics is going to perform very well. And it's not just the stability of the income line and market rental growth around 3% per annum. It's the fact that cap rates are going to compress, and they're going to compress very hard. From our June valuations, I think cap rates on industrial have got at least 50 to 75 basis points of compression ahead of them. In percentage terms, that's 10 to 15% on top of 3% per annum income growth. So you can see the sort of total return that logistics is likely to produce over the next 5 years.
We just had a question from Charles Gallotta, which you covered most of in industrial, but he was talking about the leasing and have you seen it? Was there a point in the COVID where there was a dramatic increase of, as retail was dropping off, or has this been a gradual thing, just the switching to online?
I think we had already seen going into COVID an acceleration in online retailing. One of our biggest customers is Wesfarmers, as you guys know. They not only own a fantastic business in Bunnings, which we are very high conviction on, they also bought an e-commerce business called Catch of the Day was the original name. The sales growth for Catch is phenomenal and has seriously accelerated during COVID. So we have Catch's main distribution centre at Truganina in Melbourne. That is a business that is typical of what's going to happen in e-commerce, where their space requirement is going to expand to requiring warehouses in Sydney, Brisbane and Perth. So I think right throughout, Australia Post is another beneficiary. While Snail Mail is losing its money, its package business and effectively being an e-commerce provider for parcel deliveries is driving huge space increased demand for warehousing. And we're seeing it with a whole range of other e-commerce customers. So I think it's going to be, I think COVID has created a step change. Australia had one of the lowest online retail penetrations in the world, and we've got a long way to catch up. And I think we see a pretty significant increase there. I think the really good retailers are the omni-channel retailers that will combine both online and bricks and mortar and do it successfully. And if you think about why Wesfarmers bought Catch, you know, without giving away too much, there's no doubt that they will utilize that business and that technology to also drive online sales in their other businesses, whether it's Kmart and Target, etc. And Bunnings, being originally a slow adopter, have also announced that they are accelerating their omni-channel approach between bricks and mortar and online. And in their case, because the product is in those retail warehouse stores, theirs will be very much a click and collect model, more so than sort of home delivery. If I move on to some of the other sectors that we think will be significant beneficiaries of what we've just seen, we think the corporate triple net lease sector, not just in industrial, we have a big conviction bet on long leased assets where the underlying land value or vacant possession value without the tenant is a high percentage of what we're paying. We don't like to overpay for an income covenant. And so when I look at service stations, we're not naive. You know, there'll be structural change from a fossil fuel perspective, but we're sitting on land where the underlying land will outpace the investment value of those properties over time. So have a similar view on Bunnings. You know, the big proportion of the component of an investment value for a Bunnings asset is in the land. So, you know, I think the triple net sector generally, particularly with solid tenant covenants, will keep pace and potentially even outpace the total returns in logistics. If I turn to other sectors, there's no doubt the most heavily impacted sectors from COVID are hospitality, particularly, you know, accommodation, hotels, and obviously retailing, as you mentioned, shopping centre retailing. If you look at our shopping centre portfolio of about 4 billion, there's nearly 60 supermarkets that anchor those shopping centres. Coles, Woolworths, Aldi, they've actually had record sales growth. The specialties, yes, have had impacts, particularly in Victoria, where there's been, obviously lockdowns. But as a general theme, we're seeing assets that we want to sell, we're able to get book value or above. I think cap rates are going to be pretty stable at that convenience end of the shopping centre retail market. I'm much more bearish about discretionary retail. I think what I've just talked about is going to create a lot of uncertainty around discretionary retail, and therefore the top end of shopping centres, regional malls are going to continue to see the asset value declines that we've already seen. I predicted 30% peak to trough valuation falls in that sector based on valuations that have been reported, given that the peak of that sector was probably June 19. We're probably halfway through that devaluation cycle. Office is obviously the big question mark on people's minds. Our view is that it's way too early to be calling a structural change to the demand for office. We're not convinced that there is going to be a structural change and everyone's going to be working from home permanently. I think there's two offsetting impacts. Forget COVID. The fact that we're going into a recessionary environment is going to dampen demand for office. Conversely, everyone is going to require more office space per person. So when I started in this industry 33 years ago, we had a very healthy 25 square metres per person. We've got down to about 10 to 12 square metres per person, and that's too dense. So we're shifting back to about 15 square metres as a minimum per person. So you're going to have even organisations that reduce their headcount doesn't necessarily mean they're going to reduce their office space. There's a lot of media hype around whether or not we're going to see a desertion of tenants from CBDs to suburban markets. I don't think that's going to happen. I think there'll be some examples There's already government decentralisation in Sydney to Parramatta, but I think, you know, ultimately the workforce will need to stay connected. The risk management elevation or risk elevation and lack of productivity that comes from a long-term period where your people are working from home just doesn't work. So there'll be some organisations, you could see call centres, for example, move to sort of 50-50 work from home, work in an office type environment. Technology's obviously allowing them to do that. But at the same time, I think we're going to see winners and losers. There's going to be some industries that contract and some industries that continue to outperform. We have got the lowest exposure to professional services, you know, dominated by accountants and lawyers than any of our peers. We have purposely not wanted our office portfolio to have much more than about 12 to 13% of our total income coming from, you know, lawyers, accountants, and various professional services. If you scratch this, if any of you have been in a partnership, if you scratch the surface of the balance sheet of a partnership, it's not much there. So we've tended to focus on government, high quality corporates, big focus on tech companies. We're the biggest office landlord to Amazon in this country. And I think you'll see, you know, the winners and losers in office, and the longer leases and the stronger covenants will prevail. And office assets, particularly B grade, C grade assets, will really struggle to keep their tenants, given that there's going to be a heightened need for the highest quality office space, all sorts of hygiene innovations, and therefore we'll see a sort of flight to quality. And then when I sort of look through to some of the, you know, the other, if you like, alternative sectors we like, we're making a big push to grow our social infrastructure portfolios. We're the biggest landlord for childcare centres in the country. We've expanded that with, you know, acquisitions like the Brisbane Bus Depot last year, where we got a 20-year triple net lease to Brisbane City Council, the biggest local government council in the country. We also just recently announced a new office 10-year leased investment with the Mater Hospital in Brisbane as the tenant. So I think that social infrastructure thematic will play out. And as I said, if you can get long-term leases with government or government subsidised industries, which is obviously what childcare is, I think we're going to continue to see cap rate compression and income resilience. So sort of from my perspective, you know, frankly, both in an absolute and a relative sense, I think investing in good quality commercial real estate will be a very strong alternative to alternatives over the next 10 years. We're all the same, whether you're a high net worth investor, a family office, or, you know, a large pension fund or sovereign wealth fund. We can't survive with income returns out of fixed interest and bond yields, and even adjusting for inflation, however modest it might be. The negative real returns is going to send money towards other higher yielding alternatives, both in the unlisted and the listed world. So we see a significant acceleration of capital coming into commercial real estate. We've only just started touching the sides of a huge move of insurance companies moving what have been predominantly fixed interest investments and moving into property. And that's global insurance companies and domestic. And I think we're going to see, you know, quite a surprising for many strong total return performance out of good quality commercial real estate over the next 5 years. So, you know, I'll hand over to Miriam and talk specifically about some of the things that are our best ideas. We specifically have created what I call an umbrella fund. It's called WPS1, which is our Wholesale Property Series 1 fund. It's got some private equity structural characteristics where you put your money in and you get all your capital back and the profit over an 8-year period. And we've structured this to give our, retail, sophisticated investors, high net worth, ultra high net worth, and family office investors the opportunity to get exposure to all of our high quality wholesale funds that you can't normally invest in. Most of our wholesale funds have a minimum, or they all have a minimum $10 million individual investment, a whole range of stamp duty reasons in different states. And you'll see, from Miriam's analysis, there's a very high tilt in that fund to, the best performing sectors I talked about: industrial, logistics, Bunnings, social infrastructure, the Telstra exchanges. So, I've invested in the fund. I think it'll be a very strong risk-adjusted performer, and it's really designed as a sort of cost recovery product for us to give our high net worth investors an opportunity to get access to the wholesale funds that you just normally can't get access to. So unless there's question, James, I might just hand to Miriam and then we can take.
Yeah, I think that's good segue, David, and then we'll come back. Got a lot more questions, but we'll hear from Miriam. I'm sort of interested how you've structured these partnerships as part of your model, and then how Miriam's using this as in creating this sort of high net family office type vehicle.
Yep.
So, Miriam, over to you.
Thanks, James. So I'm going to cover 3 things today on the Charter Hall Property Series number 1, or WPS1 as we call it within Charter Hall. We love our acronyms. Why we've created this product, how we've gone about it, and the key features of the fund. So why have we created this product? As David's mentioned, if I reflect on our business and where we currently have good coverage of large wholesale institutional space, as well as the smaller retail end. However, we identified a gap in the market in catering for the needs of organisations in between. We spent a lot of time thinking about what product would appeal to high net worth and family offices and how we could make this a unique offering. What was important to us was not just about this product, but it was also about the potential to develop an ongoing relationship with you in the future. And as you would have heard from David, we manage over 60% of the capital that we manage is on behalf of high profile superannuation, global pension and sovereign wealth funds. And what are these funds typically seeking? They're seeking the highest quality real estate in the country. So you may ask, what's important about high quality property? And as David alluded to, high quality real estate is typically able to be leased through the cycle with lower vacancy or income gaps, and therefore providing a far superior risk adjusted returns, both in terms of income and capital appreciation over the long period, over a long time horizon. So until now, the ability to access such high quality property has been prohibitive, as the entry point or the minimum buy-in has been approximately $20 million for our wholesale institutional partnerships and $100 million for our partnerships. And therefore it does make it difficult to access, particularly when considering the desired level of diversification across the property sectors. So we have designed this product, WPS1, for high net worth and family offices to gain access to Charter Hall's best performing institutional funds and partnerships across our business. So effectively, it provides access to Charter Hall's best investment ideas for a materially lower threshold of $250,000. And what makes this product unique is not only does it lower the minimum threshold to access our flagship institutional pooled funds, but it also provides a level of exclusivity to WPS1, as it allows access to the institutional partnerships which not even other institutions are allowed to access outside the founding institutional partners. So if you're thinking about where this may sit in terms of your portfolio allocations, the way we've designed it and the way we think about it is that it very much is aimed as a highly defensive component in your portfolio. And unlike many retail funds, this fund is very much total return focused, delivering with a target return of 8 to 9% after fees, with a 50% weighting to income. So how have we gone about it? And as mentioned, WPS1 consists of Charter Hall's best performing funds and partnerships. And in accessing these partnerships, we undertake tactical allocation across these funds on behalf of investors. And these are signed off unanimously by by the independent members of Charter Hall's, of WPS1's investment committee. And these independent members consist of Piyush Gupta, Rick Higgins, and Glenn Fraser. So importantly, the fund allocation is not static. And to give you a flavour for this dynamic fund allocation, from when we launched in March, the fund looks vastly different to where we are today. So if I can give you an example, we pivoted from, as a result of the changing market conditions and outlook for the respective sectors, we pivoted and upweighted to industrial and logistics, which, as David mentioned, is benefiting from enormous tailwinds to e-commerce. We upweighted further to the triple net lease thematic, which we have a very high conviction on, to Bunnings assets and also data exchange infrastructure assets. And as David mentioned, what we like about long leased assets is that in addition to the rent that the tenant pays, the tenant is also responsible for all outgoings, including of a statutory nature, which means that we're not paying large dollars out the door for CapEx. And so therefore there's a greater line of sight to durable income. And in fact, some of the funds in here, these triple net lease funds, have been Bunnings in particular has been the best in performing investment across the Charter Hall portfolio. And lastly, we've underweighted to office, and I would stress that whilst this is not because we've given up or we don't like office. We just intend to run the fund at this point in time underweight until there is greater visibility on the outlook for outlook and pricing.
Just a quick question. Is it a commitment and a drawdown structure, or is it you invest your money day one?
So unlike, I will come to the structure of the fund, but yes, unlike private equity funds where there can be a delay between commitment and drawdown, because these underlying funds are already in existence, we are able to deploy directly into established portfolios. And this is really important because unlike typical or classic private equity funds, it doesn't result in a drag on returns. So that probably is a good segue into the fund structure. And we did design a fund that we felt would be familiar and relevant to our target audience. And therefore we followed a closed-end structure similar to that of private equity. And in terms of the fund, it consists of a 2-year equity raise period, a 3-year investment and recycling period, and years 5 to 8 the realisation period.
Can I just add, because we're doing immediate allotment, effectively over the 2 years, we're going to raise equity, you get allocated immediately. And as Miriam said, we're able to deploy immediately because many of the partnerships, whether it's the Bunnings partnership or the Core Logistics partnership, we've been able to convince the major investors, and in both of those, you've got 2 big Aussie investors that own 80% of the equity. We've been able to convince them that WPS1 will be able to invest immediately as it raises equity and be deployed immediately. And the reason why those super funds are happy for that to happen is that additional equity gives them further dry powder to put their foot on further Bunnings assets or further logistics assets. And ultimately, the other thing I'd say is in the early stages, Charter Hall Group, because it's got $2.5 billion invested in all of our funds and partnerships, we're able to seed this with this fund with equity invested in those funds. But the majority of the equity going forward is being allotted, providing those partnerships and funds further capacity to either develop the core or to further acquire assets that are accretive to each of the partnerships and funds. Sorry, Mim.
No, that's all good. Thank you. So how it probably follows into how we will generate liquidity and return capital to you. So similar to our active fund allocation process, our job together with the Independent Investment Committee is to manage the exit of the fund investments over time. So an important aspect of investing in these funds in the first place is line of sight to defined liquidity events. And all these funds which comprise WPS1 all have the ability to access liquidity prior to the WPS1 fund wind up. And this was an important criteria to the Independent Investment Committee in the fund selection in the first place. From a fees perspective, because we've never had a product like this before, and as David mentioned, it's a very much our strong focus to create a new market segment in our business. Consequently, at the WPS1 level, we are running on a cost recovery basis of 20 basis points, management fee plus a trust admin fee of 15 basis points. And whilst the investors pay the competitive and highly negotiated rates that wholesale investors pay in the underlying funds. So in terms of debt, you may ask, does WPS1 have debt? The answer is no. Unlike traditional fund of funds, there is no gearing at the fund level or gearing upon gearing. The only debt is at the underlying wholesale funds and partnership level, which as at September is 35%. So finally, before I conclude and open up to questions, if I can leave you with a flavour for the fund metrics where we stand today, I'll just read you a couple of stats. WPS1 it's highly diversified. It's got 206 properties, is 99% occupied, providing a yield of 4.5%. And the fund weighting is currently 45% industrial and logistics, 44% weighting to long WALE hardware and social infrastructure, specifically data exchange assets, and 11% office. And importantly, the top tenants, and again, going back to David's focus of our business in terms of focusing on government and high quality tenant covenants, the top tenants in WPS1 are Telstra, Bunnings, Woolworths, the federal government, and Inghams, and together they make up in excess of 50% of the tenants by income. So as you can see, these type of tenants are extremely resilient in the current environment. And lastly, the weighted average lease expiry is 11.2 years. And importantly, this extends beyond the tenure of the fund. So it provides extremely strong line of sight to durable income over the investment period. So that concludes the WPS1 overview from my perspective. So I'll hand it over to James to moderate any questions you may have for either David or myself.
I'll just add a couple of clarifications. When Miriam talks about data centers, we do not take OpCo risk. So they are all leased to Telstra Corporation on a 21-year WALE. They're triple net leases. As with all of our triple net leases, the tenant is responsible for all outgoings, including structural repairs and maintenance. The other thing I'd say is that the way the back end of this 8-year works is that you progressively get your capital back roughly from year 4 through to year 8. And the reason we're able to do that is each of the funds and partnerships that WPS1 invests in have either 5 or 7 year liquidity reviews, and it allows the fund to withdraw its money from that investment at that liquidity review. So we are mandated to, when those liquidity reviews to come up, is to liquidate our investment in the underlying fund and partnership, hand that capital back to our WPS1 investors. So if you put in $1, you eventually get your dollar back plus the NTA growth, as well as obviously the running yield over time. So it's really the back end of the structure that is similar to private equity, not the front end, as Miriam outlined. So over to you guys, James.
Yeah, thanks, David. Look, we've got a couple of questions. One was, there will be, post this session, we'll send you the deck and the link to the recording, and then the IM or PDS will be available to anyone who's interested. So that's coming. Couple of Michael Brown's just said, I heard Ingham's. What category of property is that? So maybe do you want to talk about the Ingham's relationship?
Yeah, so the Ingham's tenants are prime industrial assets in Sydney, Melbourne, and Brisbane. They were assets we acquired before in these wholesale funds before Ingham's was listed. We knew that they would be listed, but they've got very high underlying land value and alternative uses. So they're not chicken farms. That actually is a different portfolio we call agri-logistics. That's not in this fund. And the other thing I'd say, just the way you think about real estate, at the underlying fund and portfolio level, you've got a very long unexpired lease term, or what we call WALE in the industry. And you've got an average fixed annual forecast rental escalation of close to 3%. We also lock in our debt in all the underlying funds. In fact, the Telstra Exchange portfolio, we've just termed out bank debt for 10 years at a cheaper margin at 155 over than the 5-year bank debt we secured last year, pre-COVID. So if you sort of think about roughly 3% income growth with no rental voids and capex that Miriam outlined, and you've got fixed interest expense, you can get an idea at 35% gearing why the underlying investments are going to provide 4% plus DPU growth to the investors in WPS1. So not only is it an attractive entry point yield, but you're going to get good income growth as well as our view of capital growth.
David, we had a follow-up question. You started talking about, when you started off, it was 25 square metres a person, and it sort of got down to 10, 12, and you're targeting around 15. So the question was around, how do you see that playing out in terms of the net impact on office rents going forward?
Look, my view is that this is not a structural change in the space demand overall. Those two things, I think, will more or less offset themselves in a normal economy. How deep and how long the duration of a recession is will determine ultimately how many corporates shed space. What I can say is that one of the positives that's happening in the office market, big government's getting bigger. So we're doing government leases. We've just gone to Parliament for a new 30,000 metre pre-lease for the Commonwealth Government on a new office building in Adelaide. We've just extended and expanded the space on numerous government tenancies in all states. So, overall, I'm pretty relaxed about the impact on market rents. Through every cycle I've been through, when there's some weakness, most of the time the face rents don't move and the incentives go up. So there may be some reduction in what we call effective rent, which is the face rent less the incentive. I think that'll be relatively short term, maybe a year or two. And as I said earlier, I think any office assets with, you know, decent unexpired lease terms of 7-8 years and more, and we've got a lot that are even more, a lot higher than that. I think they're actually going to go up in value. So our whole office portfolio was independently valued in April, then again at 30 June. It will be done again at 31 December. More or less, our office valuations are down about 1% from December. I don't actually expect them to change much at December. And I'll just leave a fact with you that helps you understand the resilience of office assets. Our average rental escalation across that $21 billion portfolio locked into the leases, whether they're government or corporate tenants, is 3.6% per annum. So each year, if your passing rent's going up at 3.6%, roughly that can offset a 25% decompression in cap rates. So cap rates could go from 5.25% to 5.5%, and your asset value will stay the same. So I'm actually pretty relaxed about the future of asset values. As I said earlier, there'll be exceptions. There'll be, you know, short lease assets or assets that get, you know, end up getting big vacancies, particularly lower quality, that may be impacted. But the sales evidence that's already emerged during COVID is suggesting that, you know, office values are going to hold up.
I'm just going to switch to retail now briefly. You mentioned in your portfolio, a lot of your anchors have had record sales in the non-discretionary side of things. Obviously the Bunnings, you know, particularly New South Wales. I think Miriam said you're looking forward to actually being able to get to a Bunnings soon, a day out at Bunnings. The question was around the specialties and the change from a fixed rent to more of a sort of a turnover type rent. What's your view on that, David?
So let me split retail between the way we do it, between, you know, our long WALE retail leased to Bunnings and, you know, Caltex or Ampol and BP, etc., and shopping centre retail. So we've got $4 billion of shopping centre retail. None of this fund is investing in shopping centre retail. We've purposely steered clear of that. And then if I look at our shopping centres, you know, roughly 70% of the income's from the anchors, or what I'd call essential service tenants. So there's about 30% that you'd call at-risk specialties. We've only got 8% of the shopping centre income exposed to fashion and apparel. So we're probably in a very different position than the big discretionary, you know, Westfields and Vicinities. What I would say is that we have worked with our tenants to provide not just rent relief under the commercial code, which we're mandated to do, but also to help fashion retailers get through this tough period. We are not agreeing to any long-term conversion to turnover rent, full stop. We are not doing it. We will, and we have provided some short-term relief, both in the form of, you know, rent-free and rent deferment. But I don't think our retail will necessarily have, you know, the demands that the big regional malls have got to move to turnover rent. And there's a simple fact: our occupancy cost is 10.5%. Now, what that means is our gross rent as a percentage of the sales of our retailers is 10.5%. In a regional shopping mall or a super regional, you're talking 18 to 20%. So the affordability factor in the sort of retail we have is much better for the specialties. But I'm here to tell you the reason why I think it'll be the worst performing sector of all the ones we invest in is that, you know, specialty retail will be under pressure. These retailers are going to take time to recover their sales. They've got what I call the COVID hangover, but they've also got this massive e-commerce competition. So it's not going to be pretty. So I'm a realist. But what I would say, just like all the predictions about office, it's too early to say, James. I think we're we need, you know, a fraction of time during calendar year 21, particularly hopefully post lockdowns, for us to see how consumption rebounds. There's no doubt monetary and particularly fiscal policy is designed to stimulate the economy. And, you know, I am hopeful that will help reduce what otherwise would have been a pretty ugly unemployment rate. But, you know, it's just, you know, it's hard to see discretionary retail bouncing back for a couple of years. So I think it's going to be pretty tough, and hence my earlier comment. I think we're halfway through, you know, a sort of 30% peak to trough devaluation of shopping malls. And if you don't believe me, just look at the way the REIT sector trades for the regional shopping mall owners versus, you know, Goodman, for example.
So just on the REIT sector and putting that hat on, you've had a bit of a roller coaster, but you're back to sort of pre-COVID sort of levels now in your share price. Just want to compare the GFC to this situation and how being diversified's really held you up so well.
Yeah, well, first of all, I'd say that the listed market is completely irrational. For us to go from $14 to $5 back to $14 just tells you how ridiculous the listed world is. The GFC was fundamentally a financial crisis, and it was from a commercial property perspective in Australia, we performed very well compared to other parts of the world. I think peak to trough, good quality institutional assets might have dropped 10, maybe 12%, and then recovered fairly quickly. So the financial crisis was a real credit squeeze, and the REIT sector particularly went into the GFC much more overly geared than the REIT sector went into this crisis. So I don't think there's a credit crisis. Certainly for institutional quality owners of real estate, we can still get debt. The debt capital markets are open for good quality issuance. And as I said, you know, we're basically borrowing 10-year money at 2.3 to 2.4%. One of the funds that this WPS1 invests in, which is our flagship industrial fund, CPIF, just printed 500 million of 10-year money at 2.3% 2 days ago. So, you know, when you're passing yields of 5% plus and you've got fixed debt for 10 years at 2.3, you can do the maths. What yield on equity you can get with sort of 30% gearing, post pre and post, you know, our modest fees. The other aspect to this crisis versus last time is that it's not easy for some. Certainly people trying to do construction and development, you know, are going to have to access non-bank debt. But, you know, this is a consumption crisis, ultimately. With rising unemployment, you're going to have an issue with consumption. As I said earlier, I think the stimulus is going a long way to helping deal with that. And, you know, ultimately, with where I think rates are going, which is going nowhere, I don't think we're going to see a credit crunch. So it's really about the income line at an economic level that is the issue. And this is where you've got to be really selective about the quality of your tenants, the industries they're in, whether or not they're going to be able to outperform peers in that particular industry. So it's no accident when you look at all the industries, we're picking the first or second best player in each industry. You've got to do that, and there'll be winners and losers in each industry. So hopefully that sort of, you know, roundabout way answers your question.
No, it certainly does, and obviously with some very large institutions as your investors, their desire to have fairly low gearing and 35% at those rates gives you plenty of leeway in the portfolio. So, David,
I'll just add, James, that 35 is an average. You know, most of the big funds that we're investing in WPS1 have got sub 30% gearing. We take a view, which I think is a sensible view, that if we've got 15, 20 year triple net lease portfolios, you should have higher gearing because it can tolerate it. So in our whole 45 billion, you know, we've got some funds that are geared at 40, 45%. So also partnerships with a really big global capital. And then the vast majority of our peer funds, whether they're listed or unlisted, they've got pretty modest gearing between sort of 25 and 35%.
David, I think we've got a bit of a technical hitch there. You try again.
Yeah, I was just saying.
That's better, yeah.
Yeah. I was just saying that, you know, the level of gearing in most of our pooled funds is sub 30%. But if you've got long-term lease portfolios like 21 years to Telstra and you can term out 10-year debt, you should be gearing it at 50%, which is what we've done. So that 35% Miriam talks about is an average across all of the funds and partnerships that WPS1 invests in.
Well, thank you, and congratulations to you and your team. It's great, and I think the product is very innovative. The fee structure is highly competitive, and I'm sure GIC has negotiated pretty good rates with you, so 20 basis points on top of that, still very good. So, look, thank you everyone for joining us. We're sort of coming up to our hour. We will send out the deck as a thank you. We'll CC you to the team so you can follow up on any aspects, ask more questions, and enjoy your golf in Victoria, Melbournians. So
Thank you.
See you later.
Yeah, thank you.
Thank you.